Hello everyone and welcome to a webinar by Alpha over Beta. My name is Alon. Today we're going to talk about the daily investor's routine. What is the routine? What is the daily plan of an investor? What are the steps that an investor should take in order to maintain a portfolio and keep it a winning portfolio? So the things we're going to talk about today are the 5 steps of the daily process. What constructs a daily plan? What are the steps that needs to be taken in order to complete that plan of about 5 steps? And we're going to check those 5 steps. What's the importance of a trade journal? A trade journal is one of the more important elements of a daily routine. We're going to see where exactly it fits and what should be in there. What is the information that should really sit in the trade journal. We're going to talk about elements of an open position. How do you manage an open position? What about an open position that is already open and should be managed in order to be in the most effective situations and a winning position? And we're going to add salt and pepper to the presentation. We're going to discuss a lot more stuff. Disclaimer first, Alpha over Beta is an online investment service. We provide data and quotes and charts and triggers and webinars like this one and market outlooks, but really you should really be informed about the risks and costs associated with the trading with the markets, with the investment vehicles that you are invested in, and you should really adjust the risk to your own risk profile and what really suits your own risk appetite. Some words about me. My name is Alon. I'm the founder of Alpha over Beta. I have been trading the US stock market since 2005. I've been trading stocks and ETFs and options mainly. I give lectures on trading the US stock markets and have mentored many students on their way to become a successful trader. In Alpha over Beta, I lead the research and trading team which is focused on longer term returns and lower risk and as high returns as possible. This is our main focus of many of the portfolios that we offer as a service on Alpha over Beta. So let's dive right in. What are the 5 steps that should construct a daily plan for any investors? Once you sit down, you have an hour, maybe more, to invest in the market. You'd like to make the most of it. You're looking at the charts, you read the news. How do you fit all those pieces of the puzzle together into a daily plan? So what we're going to check out now are 5 steps which I offer you that you should follow on a daily basis in order to make the most out of your time investing in the market. If you are a retail trader, you know that finding time to invest in the market can be a bit challenging because you have other constraints, other time constraints, and you're trying to maneuver the schedule in order to find a way to trade the markets maybe on a daily basis. Now, once you sit down and you do that, you actually sit down and you find the time to put some effort into this and you want to make the most of it, you should really be efficient. And the only way to be efficient is not to be all over the place, is to concentrate on 5 steps, and these 5 steps are going to lead the way and make the most of the time and resources you have to invest in the market. So step number 1. Step number 1 should really be an event that happens before the market opens. Before the market opens, you should really put some time into updating yourself where the market is, what are the currents, where are the winds, where the headwinds coming from, what are the talking heads on TV say. I don't really mean that you should listen to every word a trading guru says on TV or online, but what I really mean is that you should be updated. You should know what the market is telling you, and it's really easy to get access to news information and all the data that you need before the market opens. You can always go to any news media regarding that is focused on the markets. It could be Yahoo Finance, who is a really veteran in that area. They have a lot of very good articles that you can read before the market opens. And there are many other websites that you can use to be informed where the market is going to. MSNBC offers some videos, so you don't have to read. If you don't have time to read and you'd rather listen or watch a video, that's fine, as long as you know what the market is. What's the buzzword around which the investors are talking about? You should really be familiar with that. Are they talking about the interest rate? Maybe they're talking about earnings. Maybe it's the war with the trade war with China. Maybe it's North Korea. You should know what they talk about. Again, I'm not saying that you should hang on every word that they say and run and invest just because someone said something about some stock. The truth is that it should be the contrary, but we're going to talk about that maybe sometime. But for now, all I'm saying is that you should be updated. If there's an avalanche coming, and you should know about it. If there's a tsunami coming from any direction, you should be informed. So the way to do that is go to some website that is really concentrating its news and headlines around market. As I said before, Yahoo Finance can be a really good example of that, and you can read the headlines, you can watch the video, you can listen to the podcast, and you should be familiar with the buzzwords that all the traders are concentrated around. So this step should happen really before the market opens. One more thing you should do before the market open is create the universe of candidate. Now, what do I mean by that? You can't go and invest in all stocks and all the ETFs and all the options and whatnot, all the futures and whatever investment vehicle you choose. There's just too many of those. And you have to somehow filter out of all those thousands, really thousands, of assets classes that you can invest in. You should really somehow create your own universe, which is a starting point from which you select the right candidates. Now, such a universe can be, for example, the Dow 30. This is a really simplistic example of something that you can say, well, I'm not going to invest in all the stocks in the world because, well, there are just too many of those. And then if you want to add ETFs and options to the picture, you're just complicating stuff. So what you should really do is concentrate yourself on the first universe that you should create in order to make a starting point. As we said before, the Dow 30 can be a good example for that. What is that? That means that you're not going to invest in all the thousands of investment vehicles out there. You're concentrating yourself on the Dow 30. Now, 30 stocks is definitely something that is manageable. You can control 30 stocks. You can go over 30 stocks every day and just see where they stand, what you should go long, where you should go short. Maybe you should get out of an investment that you already have. 30 stocks is something that's manageable. It's definitely manageable. And if you have an opening in one of the Dow 30, you go over the Dow 30 every day or every other day, and you know that this is the universe that you select from. Another example, let's go over to Finviz. Finviz has a very simple yet powerful screener that can actually screen a lot of the assets that are out there and create a small universe that is actually manageable by reducing the number of assets that we're going to control. So if we're starting with, as you can see here, the total number of assets that we're starting from is above 7,700. So there's no way anyone can really control that many assets. The whole purpose of a screener, and you can use any other screener, Yahoo has a screener, and any other website that is financially focused has a screener, but you can use the Finviz screener. The Finviz screener is very simple and powerful in results, and also in results display, as we're going to see in a minute. So I'm using Finviz to really filter all those 7,700 assets into something that is really manageable, like 20-25 assets that I can really control. So when I start my filtering using Finviz, there are 3 rules that really I should employ immediately in order to get the basic results from Finviz. The first one, since I'm investing in the US stock market, I'm going to the country filter and I'm selecting USA. Now that should reduce the number, not by much, but it should reduce the number. Then the next filter that I'm selecting is just going to the price filter and selecting all those assets that have a price that is currently over $10. This is to reduce the risk. I do not like to invest or try to manage open positions in an asset that has a price that's below $10. These assets, as a general rule, really, typically have a lot of volatility in their price, and I do not wish to see volatility in my portfolio. And one other thing is, as you're about to see, there are plenty of opportunities to invest in a vehicle that has a price that is over $10. So why go with something that is really volatile and risky? Now, some investors say that the threshold is about $5. That's all right. You can select something that has a price of above $5, but again, the volatility is going to increase a bit, and shorting positions that are for stocks that are below the $5 mark is something of a dangerous. I do not recommend you going that way. Do not short positions. Do not short assets that are under $5 in price. So we're going to check the $10 price this time, and we're going to use the $5 next time. But for now, at $10. Anything that is over $10 is good for us. Now, the third one that I'm going to use is I'm going to filter by average volume. I would like to see liquid asset. I really wouldn't like to invest in something that's not liquid. So my threshold in average volume is anything that is over 1 million shares in the average volume. Now, the number that we have starting with above 7,000, Finviz should give the number is 905. Okay, so we're below the 1,000 number of assets, which of course is still a large number. There's no way you can on a daily basis manage 905 assets. It's just too much. But so what we're going to do is we're going to add another filter right now. And that filter would be a technical filter, and that technical filter should really reduce the number into something that we can control, manage, and check to see if it can fit into a starting point of a universe. So what we're going to do, we're going to hit the technical tab here, and once we hit the technical tab, we can go, let's wait for Finviz to show the technical tab. All right, so the technical tab enables you to go for a pattern, and the pattern that I'm going to select is horizontal support and resistance. As I said, this is a technical filter, but the filter should really reduce the number of assets that we are going to consider as a starting point, as a universe, as we call them, and this is a 24 number of assets. That's really good. 24 number of assets is really something that we can manage. This is a good starting point. We just filter 4 filters, and that's fine. You can use any other filter that you want. So we have 24 assets to start with. Now, one more thing I would like to show you, since we're going technically, if you hit the charts button here, the charts button here, Finviz is going to display the results as a chart and not as a list, as we have seen before. And now you can scan the universe for something that suits your investment style and strategy. So you have the 24 assets, they're listed in here, the charts is displaying this thumbnail image, and you can just scan the results and find something that is suitable for your investment criteria and strategy. So let's move back to the slides and talk about the next step. All right, so we talk about the first one, the second one, we went to FinViz, and now we're at the third one, which is checking the candidate's validity. What do I mean by that? Now that you have those 24, as we saw, the 24 that are the result of filtering like FinViz or the Dow 30, then you have a 30, you should really scan them and check them for validity. Validity means that all the assets that are in the universe should comply with some rules that are set by an investment strategy. So it's not enough to have a universe. You should have an investment strategy, and that investment strategy should set some rules for filtering the assets that are in the universe. And once an asset in the universe comply completely with all the rules that are set by an investment strategy, this means that it's ready to jump right into your portfolio. Okay? So really the third step is taking your investment strategy, looking at the rules, and making sure that the ones you find, the assets that you find in the universe, you find something from the universe that completely complies with the rules that are set by an investment strategy. This is exactly the importance of an investment strategy. It filters the rest of the assets out of all the filters that we've used so far, and it filters them and matches them and selects them as an investment in my portfolio. So let's give an example. Say that I would like my strategy to be, you have to go long if the price, again we go technical, if the price is above resistance. So we find a resistance, we find the price that goes above a resistance, and if we have an asset that is in the universe and has a price that is above resistance, this means that it complies completely with the rules of our strategy and it can go into my portfolio. All right, so we compare the two and we do a crossing of those two. It has to be in the universe and it has to comply with the strategy rules. Okay, this is exactly where a strategy comes in. Now you can have a multitude of strategies. You can have a number of strategies, that's fine. One can say long when breaking resistance, the other can say short when breaking support. That's super fine, as long as you know that you have a successful investment strategy, one that was proven as a winning strategy in the past. Of course, you can have no control over the future, but the past would have to suffice for now. So we're actually going and checking to see if there is an asset in the universe that actually complies with the investment strategy. Okay, so the fourth step is making the appropriate order. What do I mean by that? Once you have something that completely complies with a strategy, the strategy should really define what is going to be the market order that you're about to give. Okay, you're about to call your broker and say, hey, I found me an asset. It should sit in my portfolio, but it should be there in conditions, under the conditions of 1 or 2. What could be a condition? There could be a no condition, like market order. If you issue a market order, this means that the broker is going to get the asset that you want immediately in the market terms. It's going to make its best effort to find the best price for you, but you're going to get the asset immediately and according to the market terms. Now, another order type could be a future order type. You would like to get the asset if the price goes above a threshold or below a threshold for short positions. All right, so here you're playing with the market orders and you're giving the appropriate market order. If you want it to be future, then you have to make the condition for the future, like goes above a threshold. And if you're giving something that has to be immediate, then there is really no condition, and you're telling the broker, Mr. Broker, buy that asset because it complies with the strategy. The strategy, of course, defines the market order. Okay, part of the strategy is defining the market order. So the strategy includes filtering, and a market order, and something else that we're about to see in a minute. So it takes the specific market order and makes the broker comply with it, and it has to tell the broker, look, buy that asset only if it complies with the below market order. Okay, so a market order can be buy that immediately under current market conditions, or something in the future according to price threshold. Okay, fifth and last, we talked about the first 4 stages really construct something that would move an asset into the portfolio. But what about those that are in the portfolio already? They sit there, hopefully they're winning, they're not losing much, they're making money, they're running forward, they're earners, they look green on your display, everybody's happy. But you should really manage those. You should manage the losers and you should manage the winners. And the losers and the winners are already sitting in your portfolio. So the 5th step is looking at the assets that you already have in your portfolio, not the ones that are candidates to be in your portfolio. They're already there, they're sitting in your portfolio, and you should manage them. So you're looking at the open positions, you have your risk profile that again is a part of your strategy, and you should really comply with the strategy. If the strategy says, like, if the price drops, again, let's go technical, if the price drops below 8% from its peak, then you should close the position, something like that. So you manage the open position, you check to see if it complies with a strategy rule that says increase position or reduce position or close and exit the position, and then you manage the assets that are already in your portfolio. All right. Again, the last 3 steps are really, the last 4 steps really are a part of the strategy. The strategy is the wrapper of the last 4 steps, and you should find yourselves a really good strategy. We offer 6 strategies in alphaoverbeta.net. You can check them out. Head over to the website and you can explore the website and look at the strategies that we offer. But all 6 strategies do exactly that. They offer you 5 steps, so you can use those in order to enter, exit, and manage the open positions. As a matter of fact, we do that for you, and we allow you to invest alongside portfolio managers that do exactly that. They know their strategy, they follow that religiously, and the results are sent to you in case you are a subscriber of that service in alphaoverbeta.net. And then you have to do that again tomorrow. No one said trading is easy, and no one said that trading should be interesting on a daily basis. It's a routine, and you have to do that every day, every other day. If you do that every 3 days, that's fine. That's fine. If you're a swing trader, that's fine. A positional trader, long-term trader, that's fine. But you should be really with your, you should be informed of any move in your portfolio if you're doing that on more than 3 days basis. All right. So trading journal, we said that we're going to talk about trade journal. The trade journal, where exactly does it fit in the entire daily plan? So the trade journal, you can find many examples of a trade journal on the internet and use one of them. My advice, use the simpler one. Trade journal describes which asset you're buying and what asset you entered and what price you entered and what the price of the exit and how many did you buy, and all that is fine and it's technical, and you can find that using your broker information. He will provide you with the history of the assets that you bought, the assets that you exited, how many did you win, how many did you lose. That's not a problem. The only thing that the broker can never provide you is the why. And this is the important part of the trade journal. It's not how much you bought and what price you've entered and all that. That's not important. What's important is the why. And this is exactly what you should document in the trade journal. every time you make a purchase, an investment, whether it's a long investment or a short investment, you should add a line to your trade journal and you should indicate why did you enter, exit, or reduce or increase the position. This is the importance of a trade journal. And then at the end of the week, when the trading week is over, you have a weekend and you can look at the trade journal for, I don't know, half an hour, maybe an hour, and learn from your mistakes. This is the only option you're going to have to learn from your own mistakes, from the losers and from the winners. Now the winner is of course not a mistake, but you know where I'm going with this. This is the weekend and the trade journal are a highly important part of the trade process. You sit with the trade journal, you look at past week investments, you look at them and you look at the winners and you look at the why for the winners and you look at the losers and you look at the why column for the losers and you understand why you made that mistake and why was that successful. And this is the only way you can learn, by keeping a trade journal, logging each and every transaction that you make. The transaction itself with the details of the transaction is not that important. As we say, you can get that information from the broker. But the why did you make that transaction? This is what's important. All right. So I hope you've enjoyed this webinar. I hope it was informative. And I would like to thank you for your time listening to this webinar. And I hope to see you again on future webinars. And enjoy the rest of the trading week.